Hey everyone, this is Christian Pepe with First Equity Funding, and as always, I have Anthony and Cory with me here today. And today's topic for our podcast is kind of a little bit more of an open forum. I think rather than go with a specific topic, we were just going to kind of maybe discuss the current state of affairs in the real estate market. You guys, I would say, are the ones that are probably most in the forefront with clients and our borrowers who are coming to us for different hard money transactions. What are you guys seeing out there?
Well, we've seen a big shift this year in particular from, historically, we've always been a fix and flip first company. A few years ago, we introduced the rental loans that we do, the no-doc rental loans, which had always been popular. But I would say this year in particular, that's become the lion's share of our business.
Mm-hmm.
I think really driven by the fact that home affordability, is almost non-existent. I mean, the prices are through the roof. So finding deals that make sense to fix and flip, they're getting harder to find. So a lot of investors are pivoting to more rental property strategies.
Okay. And what do you think makes because you're saying that home prices are going up. So how do you think investors are still making sense of buying a property and getting its cash flow?
There's definitely been some investors where I feel like the market shift upwards has helped them. So you have a $20,000 overage, but then your end price just went up by $50,000 over the 6 months that you were fixing the thing. So
you're saying on the fix and flips, you're saying
short term, but
kind of rising tide raises all boats kind of thing.
Yeah, but I think we're I don't know what we were just saying before we started this. I mean, a little bit we're seeing a slowdown on the realtor side of things, and as far as open houses, and it seems like
I would just say locally, we're in the New Jersey market. Our office is at the Jersey Shore, and it's been pandemonium here since COVID, kind of coming out of COVID. A lot of people have a lot of Manhattan or New York money that has kind of shifted the whole work from home kind of thing, and I think more recently I think a lot of people, and this is more anecdotal, just people that I know that work in the city, maybe I think we're thinking that they were going to be home for a longer period of time than they were, and in the financial markets, I feel like the big financial firms are starting to pull people back quickly. So I'm wondering if we're starting to see that shift, because again, locally, and we're in Southern Monmouth County, so Ocean Monmouth County. A lot of agents that I work with in the past couple weeks, and it's middle to end of July right now, have said that things have really started to slow down a little bit, and they're starting to see less people at open houses sitting, not really seeing the bidding wars, that kind of thing. So it'll be interesting to see. But getting back to talking about the rental strategy, you guys are saying you're seeing that shift. How do you think are we seeing rent increases as well as what's helping the cash flow kind of work?
Yeah, well, as we know, anybody who's been to a supermarket lately, or who's tried to buy a host of other things, sees the inflation. The Fed and the government's calling it transitory, like a temporary kind of thing. But when you inject literally trillions upon trillions of dollars into the system, prices rise, and that includes rents. And so, I saw an article the other day, particularly, and it's funny because you mentioned an article about rents in primary markets going up, and I was reading something totally different about rents in secondary and tertiary markets also going up. Mm-hmm. And I guess the point is rents are going up across the board, just like the cost of housing,
right? Just
like everything else is going up. And so that's, if you're on the other side of that as the landlord, that certainly helps you combat the fact that you're buying a property for a more inflated price, but you're also probably getting a little bit more in rents, at least in the short term.
And then interest rates, right? Even our rates, obviously, the conventional rates have been low and have remained low. A little bit more volatility the past couple months than maybe what we saw, at the middle to end of last year. But, there's this whole market of this private DSCR lending that we're doing. And, we've seen, there is secondary markets have opened up. There's an appetite for these loans, and we've seen our interest rates come in considerably. So I guess price values going up, but interest rates coming down and rents going up has still made it make sense. And I know Cory, for example, you do a lot with investors that are working in other parts of the country. I mean, we laugh about how much property taxes are in the tri-state area. We look at some of these deals that investors are doing maybe in the middle part of the country, and
$800.
you see like $800 for taxes, right? And you're like taking a triple take at that, where that could be the monthly
a month
tax
or a year,
that could be a monthly tax amount in New Jersey. Oh, yeah. So that's interesting too.
Yeah, especially when you got rents that are not crazy high like they're here in New Jersey, but they're $950, $1,000, $1,100. You got a little 2-family, you're paying $1,200 in taxes. I mean,
right?
It makes a huge difference at the bottom line.
Sure.
Not to pull a Rogan on you, but pull that mic up.
Sorry. Okay. Too far away. Sorry.
But yeah, it's a big difference between like $8,000 in taxes in New Jersey for a 2-family versus there's a lot more opportunities I think in other parts of the country, which we're kind of seeing a lot of movement too.
And as we've expanded nationally, and we've lent in, I don't know, at probably most of the states around the country, coast to coast. One of the things I'm realizing lately is that in New Jersey, or the tri-state area for that matter, I always talk to borrowers about, maybe start looking at multifamily property, right? Like a 2, 3, or 4 unit is usually going to cash flow better than a single family home, for the reason that, a 4-unit property isn't 4 times the cost of a single family, but you are getting 4x the rents. That seems to work here, but we've done a lot of deals lately. I'm just thinking of like Oklahoma, Missouri, Mississippi, Louisiana, where you can buy a brand new or single family home fully renovated for $200,000, and the taxes are nothing, the insurance is very little, and they cash flow great. Yeah, and so we're seeing that's probably a good strategy, in those parts of the country, and I think even better, in the sense that those single family homes are really the ones seeing that price appreciation. So not only are you having properties that cash flow that would never cash flow in the Northeast, but they're also, appreciating in value fairly quickly.
Yeah. And mentioning the appreciation, I think there is in especially like the New Jersey or tri-state market, sometimes it is a little bit of an appreciation play, right? Like I was on the phone with an investor just literally a few minutes ago who focuses in, Monmouth County, and he likes, focusing on townhomes or condos where there's really not a lot of maintenance, and, he's okay. And he's like, look, admittedly, I don't make the, as much of a cash return, but he's like, I feel like I'm buying, maybe nicer properties that I think are in markets that might have the ability to appreciate a little bit more. And he thinks he'll get higher rents and, arguably maybe better tenants. You know what I mean? And he's okay getting a little bit less of a monthly return, feeling better about the property. So it's interesting to see how everybody, approaches it a little bit differently.
In real estate, the best way to do things, I think, is buying in the path of progress. So like a lot of these areas, like you're outside of Charlotte and kind of these submarkets, there's not going to be properties selling for $125,000, $150,000 forever. We see property values here in New Jersey just go through the roof, and stuff getting close to $1 million. Yeah. In areas that we didn't see that coming for. Yeah. You go years back, you're still buying stuff for $400,000, $500,000. Now Middletown, you have stuff selling for $800,000, $900,000. Yeah. So it's like just seeing that big gap between $900,000 and then you go to a different state where the area is just as nice. It's just lower values. So it's like, and I've been with the company for a few years now, so I have the opportunity to work with like different investors and kind of keep working with those guys. And that's kind of what people are doing. They're just going to other parts of the country, it seems like, just to find those, the opportunities. Yeah, no, yes, people certainly have, a handle on different submarkets. The other thing is, like, I would say the Airbnb play, right, is kind of an interesting thing too. And, I know recently, we've kind of expanded our guidelines, and we are now, for a while there, and especially coming off of COVID, not knowing with travel restrictions, things like that, what those, short-term rentals were gonna look like. But now, we're starting to see, we're getting more comfortable that market is, that rental income is okay, and you could really, knock it out of the park if you.
And again, it's a great opportunity, particularly in high-cost areas like maybe parts of Southern Florida or the Northeast, where in our neck of the woods, if you find a single-family home, it's just not going to cash flow. Right. It's just not. But if you want to do an Airbnb play on it, of course, it's a little bit more management intensive, and it's more of like running a business, maybe, as opposed to real estate. But that property is going to cash flow at that point. And so that's a good way for if you want to invest in your own backyard, and you can't afford or don't want to get into like a 8 or 10 unit apartment building, maybe buying a vacation rental at the shore is something that's more appealing. No. And we can now finance it too, which makes capital for those deals even more accessible.
Yeah, so I mean, I think in summary, I mean, obviously the long-term rental strategy is really working right now for a lot of people. I mean, I know we're the busiest with that we've been, but getting back to talking about the fix and flip for a second, it's definitely, I think we're seeing less of it, and arguably because it's hard to find deals right now, right? Like, people are just bidding things up so much. There's not as much meat on the bone for investors, but are you guys for the investors that are still finding fix and flips? I mean, what kind of projects are you seeing that make sense for people that they're able to, to get done?
I've been seeing the more creative projects. So the ones where you're adding a level, or maybe, hey, I'm buying this lot with this one house where I'm gonna renovate this house, but I can also subdivide this lot and build something next to it. Just really more creative deals like that. Right now, this is not the market where you're gonna just go find a deal that needs $20,000, like paint carpets and some landscaping and put it back. Those just don't exist. Yeah.
And this may be obvious, but I mean, a lot of the stuff I'm seeing is like, it's off-market deals. Finding something listed that you can buy at a discount and then put money into and resell. Like those days are, it might come back
you
soon.
Find it, but it's more of a diamond in the rough than
right
it is,
now. Yeah, because there's
that
someone that's
makes
going to come
sense.
from out of state, or like we were saying earlier, a lot of movement going on. People moving areas, and they're going to come in and just overpay for it just because they don't care. They're going to live there. It's not an investment. It's not a flip.
But I would say, we were talking about the Airbnb vacation rental stuff. I bet you could go on the MLS right now and find a deal that would make a great Airbnb property, and the numbers would work great. On the MLS.
Yeah.
So that's like for if this is your first kind of foray into real estate, I mean, you can find deals that way on the MLS, but otherwise you got to just dig a little bit harder and find your fix and flips, direct or off market.
I'll just add to that, if you're looking at Airbnb type stuff, I mean, my first stop would be going on to Airbnb.com, going to that area and looking up rentals for myself and seeing like, okay, is there stuff available? There's stuff booked 2 months out with nothing available.
Yeah.
And that might be a good market for you to enter, because obviously there's a shortage of rentals.
Yeah. Yeah. Getting back to I totally agree. But getting back to the fix and flip and finding opportunities. Yeah. I mean, a couple of people I'm working with, they're doing, like you say, that we talk about the Papa Tops, where you're doing a Cape to colonial conversion. I think you just got to just think outside the box, and you got to be okay with, probably taking on a bigger project, and that may not work for everybody. But if you're partnering up or JVing with somebody who could do the actual work, I think that's really pretty key right now. Given the how busy contractors are, and given the cost of construction, I think is key. But
and that said, though, we know some big time flippers who right now are busy. They're doing all kinds of deals. And that's because they do things like they do their own advertising, their own direct mail. They have all these systems and processes in place. And it goes back to the thing we always say, which is the harder and harder it is to find a deal, the better deals you're going to get. Because as the barrier to entry gets higher and higher, there's just fewer people going to do it.
The part-timers are going to kind of like fade
just
off
putting a letter together and finding a mailing list and sending it out is just like, that's more than most people will ever do.
Right.
So just the fact that you do that at all, you're already ahead of
kind of old school ways of just finding off-market deals.
Yeah, whether it's direct mail or door knocking or whatever the case is, the harder it is, the better your deal is going to find, because there's just less people competing with you.
It's also like a lot of like right place, right time. Like how many deals do you know that's just like, oh, the neighbor knocked on my door and said, hey, by the way, like I have a house for sale, like down the street, like are you interested? Like I feel like it's like half the deals out there as a neighbor saying, hey.
Well, it's being active. It's putting yourself out there, not being afraid to, talk to agents and letting people know what it is that you do, and that you're a legitimate. I know in my experience, I mean, I kind of, my personal flips don't focus on it as much these days, but when I did, it was like, you have to let people know what you do. And then when you get a deal done and an agent or, a group sees that you're somebody that is legitimate, that actually can analyze a deal, give a quick answer, value it, diligence it quickly and properly, and that you're legit in the sense that you could actually get it closed. I mean, there's a lot of knuckleheads out there, the daisy chains of wholesalers and things like that. And not that, I mean, there certainly are good wholesalers, but I think personally that they're few and far between. But when people realize that you're legitimate, I think you get more opportunities shown into you, because right at the end of the day, people want to close. That's how they get paid. That's how they make their living. And they want to know that you're someone who can really pull the trigger.
And that goes back to what I was saying earlier. Wholesaling is a zero barrier to entry thing. So that's usually a lot of like younger people's first foray into real estate is like, let me go tie up some contract and try to flip the contract to the end investor. And they have no idea what they're doing very, very often. And there's no, you don't, maybe aside from putting some money down on a deposit, there's no cash needed. So, So the good wholesalers are very few and far between. And just going along that point, I mean, if you're talking to realtors, the best advice for any like new investor is like, just do what you say you're going to do. If somebody shows you a deal, either get back to them in a timely manner, or most deals are not going to be for you. Get back to the realtor and say, hey, this one's not for me because of this and this. Here's what I'm actually looking for.
Yeah.
And I know I sold a lot of multifamily, like big boy stuff. And if I had investors, when I sent them a deal, they got back to me in 5 minutes, said, hey, this is a little bit outside our target area. We're looking mostly in these counties. I would appreciate that 10 times more than other investors who couldn't clearly even define what it was. They don't even know what they're looking for.
Right.
Well, we're looking for good deals. We're looking for cap rates between 6 and 12. Like, that's not saying anything. You know, you really got to figure out what it is you're looking for and communicate that to whoever's bringing you deals.
Yeah, and I agree, and give that feedback of, you know, I've worked with certain agents that, you know, quite honestly, probably didn't fully understand what a good deal was, right? And help educating
That's
them
the other
too.
side of
You know,
it.
some, you know, realtors, that's their main focus. Some it's not. And, you know, but over time they can start to really understand what makes sense for you as an investor.
Yeah.
So cool. Where, you know, just to kind of, you know, wrap it up here in a minute, but where do you, if you had your crystal ball, I mean, where do you guys see things going, you know, let's say in the next, let's call it the next 12 months. And where do you guys see the market?
I think the Fed has their foot on the gas. The printing presses are running. So as long as they're printing money, as long as they keep rates pretty much pinned where they are, I don't really see much difference. Mm-hmm. Eventually, they're going to have, you know, just because inflation is now a real problem and it's going to continue to get worse. I think eventually what they should do is really, I mean, from an economic sense, is let interest rates rise a little bit, which, by the way, would be great for my generation, all the millennials who, for so many, are, you know, homes are just unaffordable. Mm-hmm. That might make asset prices a little bit more within reach. But I don't think they're going to change anything in the next 12 months. So I think we're going to see a lot of the same.
Okay. No, because as a politician, it's a hard sell to say, listen, some people are going to have to lose their jobs. We're going to have to pull back a little bit. It's going to be some short-term pain. Nobody wants to hear that.
Yeah.
So they're just going to keep printing money and just kick the can down the road.
Off the races.
Yeah. So, I mean, I think that's going to be the real question. Like, the market may pull back a little bit. You're saying you're seeing less activity. That's to be expected, right? But I think the real, like, economic trouble is down the road.
I question, you know, what kind of information. I mean, I'm wondering if this recent kind of slowdown, and again, this is
maybe it's summer.
Everybody out there might not,
weekend.
You know,
It's
other
nice
markets
out.
may not be seeing exactly what I'm seeing. So I mean, this is a little bit, like I said, anecdotal, but I think the media, I think there's a lot out there that's starting to talk about housing bubble and things like that. So I do wonder if people are starting to pump the brakes a little bit.
Let me see
you know
the
what I mean?
prices go down.
Seeing if things are overinflated, and you know, but. That being said, I've seen people do that for the past couple of years, and here they are. You know, I mean, if they had bought 2 or 3 years ago, they'd be in a way better, you know, situation. Have a ton of equity, you know, in their house. So it'll be interesting to see. But I personally just think that, you know, the supply and demand thing is still a real issue. I mean, there still is really not that many homes on the market. So I think that really needs to change for there to be a shift.
Well, home affordability is still a big issue, especially for younger people. I mean, you know, we saw in New Jersey, all the people leaving the city or from northern New Jersey moving down towards the shore area, you know, they were selling an inflated house price. And so when they were buying, it was just trading one for one. But if you're buying your first home, I mean, I think right now you still have the issue of homes just being out of reach for some people.
Yeah.
You know, so there's going to be a backlog of demand in that regard, I think. But how much higher can asset prices go? I mean, it can't go on a tear forever. I mean, at some point.
Yeah, no. When you're seeing double-digit price appreciation year over year is, you know, not sustainable.
And it's a whole confluence of things, right? It was COVID. The interest rates were slashed. There was the flight out of like, you know, the Northeast. You know, whether it come into the suburbs of New Jersey or down to Florida. You know, plus the limited supply, all that stuff has kind of got us where we are.
How many of these I guess banks that are kind of holding on their balance sheet, all these foreclosures they kind of put a hold on because of COVID.
Yeah, sure.
Like,
The more foreclosure moratorium, how much of that inventory is gonna hit the market?
That's just
be interesting to
hold
see.
right now. Yeah.
Yeah.
What are your thoughts on the next 12 months?
I don't know. I mean, I don't think it could keep accelerating. I don't see a correction, but I don't see things. I think we start to see things flatten out a little bit. I think we're going to see, you know, some inflation in the short term, but I think if the Fed does start trying to control that and starts to, you know, ease up on the mortgage-backed security, you know, purchases that they're doing, and if they do start to raise short-term rates, raising short-term rates could kind of, negatively impact the equity markets. And I think you could start to see then 30-year fixed rates, even though the short-term rates are going up, I think you could start to see them come in a little bit. But I think it's relatively flat is my opinion. But for our investors out there, I think maybe if it flattens out, you might start to be able to get, lower, less than full price offers accepted. And I do not see rental demand, going anywhere anytime soon. I think that continues to stay high. I think that continues to increase. So for the long-term rental strategy, I think that continues to be a home run play for a while. So. But anyway, thanks everybody. Thanks for listening. Hopefully you find this interesting. For more information, please reach out to us. Our email address is info@fefunding.com or www.fefunding.com. And our phone number is 732-359-7800. Thanks so much, and look forward to seeing you on the next podcast.